Today we're talking about the balance sheet, and we're going to take you through the different sections of the balance sheet. Our first section here, we're going to look at the general classifications, the current assets, long-term investments, property, plant, and equipment, intangible assets on the left-hand side, or the asset section. And on the right-hand side, we'll talk about current and long-term liabilities, and then the stockholders' equity section. We're going to close it up with a brief discussion of business entity forms and just a little bit of background for that. So, moving on. Balance sheet. So, let's start with why do we use it? And the first thing we want to do is we want to understand how are the assets on the left-hand side, or the top, depending on how it's actually presented, how are those assets financed? Where does the money come from that supplies those assets? That's called the capital structure. In broad generalization, it comes from either debt that we owe, or from stockholders who've contributed, or to the extent that they've earned it, they've left it in the company and haven't collected it as dividends. This is the capital structure. We also need to be able to compute rates of return in order to compare the profitability of one company with another, or one company with itself in a different time period. Rates of return are sometimes expressed as return on assets or return on equity. It's a measure of profitability on the numerator side, the top of the fraction, and a measure of something on the balance sheet in the denominator: assets, equity, average assets, average equity, rates of return. And then we also need to be able to analyze the firm's liquidity, solvency, and financial flexibility. These are all kind of closely related, but they are different. Liquidity is the ability of the firm to make it through the next year. Its short-term ability to pay its bills. That's liquidity. Solvency is the extent that we can make it anytime, the long term. So if you have assets that are overwhelmed by debt, may not even be due currently, but it's overwhelmed by debt, and there's no foreseeable way that you're going to be able to recover and be able to pay off the debt, that is what we mean by insolvent. Assets less than liabilities and no foreseeable way to get out from under it. Note that many people thought Amazon was insolvent back around 2000. They had $1 billion more debt than they had assets. And yet they weren't insolvent. They've made it. They had a great business model, apparently, and they made it work. Final thing is financial flexibility down at the bottom here. And financial flexibility is the ability to typically change direction or buy something if you need it. So technology companies, pharmaceutical kinds of companies, they need to have a war chest, a bunch of cash, in order to buy something that fits into their sort of mixture of technology that they have. If they don't have it, they want to be able to buy it. That's financial flexibility. Okay, let's talk about some of the limitations of the balance sheet. Most of the assets and liabilities are stated at historical cost. I would argue that I think all of them, well, it might be some exceptions, are shown at historical cost, at least originally, and then we will make adjustments to that. Historical cost is not necessarily the most relevant, but it is very verifiable, and we can get back to a source document, and for that reason, accountants like it. We know that judgments and estimates are used throughout the balance sheet, and because there's these judgments and estimates, if management does a good job with those judgments and estimates, then we're going to have good financial statements. if they do a bad job or they're too impaired by contractual incentives like bonus plans or debt covenants, whatever it is, then that decreases the relevance of and reliability or representational faithfulness of those financial statements. It's also important to recognize that the balance sheet doesn't recognize all items. The balance sheet does not report items that cannot be objectively determined. So we had a competitor move into town. We know they're going to be a tough competitor. Yet we don't show that competitor as something on the balance sheet. It's not something that shows up, but it still is going to be an item that is going to impact our business. And the balance sheet does not, by definition, include off-balance sheet financing. That's what it means, off-balance sheet. It's not included. So things like operating leases, special purpose entities that are off the balance sheet, you don't get a chance to see those. Let's take a look at the broad general classifications. The asset side, we have current assets, we have long-term investments, property, plant, and equipment, intangible assets, and other assets. We're going to go back and talk about each of these as we go through it. But on the right-hand side, we have current liabilities and long-term debt. We have owner's equity, and that includes capital stock, additional paid-in capital above the par value, and then retained earnings. And these are the broad categories, but you will see as soon as you start thinking, oh, well, I know all of the categories, you're going to see some new category that may just be very industry specific pertaining to that particular company. But for the most part, even those new kinds of categories that you see falling on, landing on the balance sheet, they usually have characteristics of one of these categories, current assets or liabilities, but mostly it's assets. Let's take a look at some examples. Here's something called Green Plains Renewable Energy. I believe they are located out in Omaha, Nebraska. And on their balance sheet, we see in the asset side, this is their asset, cash and cash equivalents, and then restricted cash, accounts receivable, and this is net of what they don't expect to collect. So the gross for 2012 would be $80,537,000 plus $219,000. So something like $80,756,000, something like that. So we add this because this is the amount of the allowance, and this is the amount after subtracting the allowance. Inventories, prepaid expenses, deferred income taxes. Notice the most liquid is listed first and the least liquid is listed last, and that's these derivative financial instruments. And a derivative financial instrument is any asset, or it could be a liability, that obtains its value by referring to something else. We have an option to buy 100 pork bellies, and that option has a value, so we can include that. We also see property, plant, and equipment, goodwill, and other assets. On the right-hand side of the balance sheet for Great Plains, or Green Plains, we see the current liabilities, accounts payable, accrued and other liabilities, unearned revenue, and then short-term notes payable and current maturities of long-term debt. So these things are really the last two, which actually turn out to be the big numbers, almost about 300 million, right about 300 million. They are truly debt, where we have an interest rate and normally would have a specified due date, and then there's some sort of things that the creditors can do if you don't pay. Typically go after the assets that we just looked at. We also see long-term debt. These are the things that are due beyond a year out into the future. And that's liabilities. In the stockholders' equity, we see the common stock and additional paid-in capital, retained earnings, and then we have accumulated other comprehensive income. This is the change in market value of those assets that are recorded at original cost, but they've gone up or down, and that shows up here. Then the treasury stock is a reduction of our liabilities, or I'm sorry, of our stockholders' equity. And then we'll come back and talk about non-controlling interests later on. But what this tells me is that they have a subsidiary that they don't own 100%. Somebody else owns, at least they did in 2011. Amazon, despite being quite a bit bigger, has a relatively simple balance sheet. We see cash and cash equivalents, marketable securities, inventories, accounts receivable, and deferred tax assets. These are all in the current section. Current means that it's either cash or items that will be converted to cash or used up within a year, and that, or the operating cycle, whichever is longer. What does that mean, that operating cycle? The operating cycle is the time it takes from when you buy inventory, pay for it, put it on the balance sheet, sell it, put it out in the retail or wholesale environment, and then collect the proceeds. So the time it takes from when you buy the inventory, pay for it, do whatever you have to do with it, then sell it and get your money. That's called the operating cycle. If you have a company that's got an operating cycle that's longer than a year, then we normally don't see the headings current assets listed up there, because pretty much everything is going to be a current asset under that circumstance. Many cases. Back to Amazon. On the right-hand side of the liabilities and stockholders' equity, we see accounts payable, accrued expenses. Those are our current liabilities. And our long-term debt is about 5.3 million. Excuse me, those are billions, 5.3 billion. We have common stock. We have some preferred stock that has been authorized. We have the right to issue it, but we have never done that. And then we have some common stock that's authorized and issued 5 million, but then we've gone back out into the market and bought it back, and that was to the tune of almost $2 billion. Again, we see that additional paid-in capital and accumulated other comprehensive loss. This is the change in market value of foreign currencies or marketable securities, and they've gone down in value, so we record that loss. Here on the balance sheet, even though we haven't, and because we haven't sold it, we report it on the balance sheet as unrealized or accumulated other comprehensive loss.